Thank you for tuning in. Today is April 29th, 2020. I'm David McPherson, the founder of Four Ponds Financial Planning, and I'm joined today by Eric Stein of East Bay Financial Services. Eric serves as our outside Chief Investment Strategist, assisting us on all matters investment related. Eric and his business partner, Mario Nardone, advise Four Ponds on investment selection and portfolio construction on behalf of our clients. Eric joins me today as we continue to grapple with the fallout from the COVID-19 pandemic and its financial impact on our clients. I thought it would be helpful for our clients and others to hear his views on investing during turbulent times like these. Eric, thanks for joining me.
Thanks for having me, David.
Let's start with a question I often hear from clients and others, and that is, why is it a bad idea to jump out of stocks when the market is in free fall and then get back in when things seem to have stabilized?
Well, that's a great question, David, and it's one we hear as well. Part of the question has to do with timing the markets, and the other part of the question has to deal with, the difference between the economy and the markets. So let's start with timing the markets first. And just the short answer is timing the markets is incredibly difficult. Part of the reason why it's so difficult is you have to be right both when you get out and also when you get back in. You have to be right twice. And what we find is there's really no scientific way, whether it's one metric or even a group of metrics, that support market timing. If market timing was easy or something that could be done, we'd all be doing it. If we think back and we look at this chart, this chart is the S&P going back to the beginning of 2020. And if we look at the chart and we think about where we were in January, we were talking about China from an economy standpoint, but it was mostly in relation to trade. It really wasn't much about the coronavirus at that point. In fact, I really don't remember seeing any economic forecasts from the beginning of the year that talked about coronavirus and its impact on 2020. But if you look at the chart and we think about it from a timing perspective, you can see that the S&P was, flat, a little bit down, a little bit up, basically through February 19th. And from February 19th to March 23rd, it went on a pretty quick and steep decline. So the question is, were there people out there that were telling investors to sell their stocks, February 17th, February 18th, again, prior to that February 19th decline? And also as importantly, were there people on, March 22nd, March 23rd, telling investors that, yep, that was the likely bottom and we should get back in and we're going to be on a little bit of recovery through the end of April. Again, I don't really remember seeing people out there talking about that. And that's really what we're talking about in regards to market timing. And this is really only over a 4-month time frame. Not only do you have to be right this time and, let's say February 19th and March 23rd, you have to be right all the time going forward. And that's just a really difficult thing to do. The other component we talked about was the relationship between, the economy and the markets. And the markets are really forward-looking. So people are making estimates on where they expect the economy to be on a forward-looking basis. It's often thought about 6 months in advance. So again, we think that prices are included, using that all the information that's available. Again, if we think about current economic conditions and even conditions that we think are going to happen over the next 6 months, that's already been priced into the market.
But isn't it true that we've never had a situation like this where essentially we've shut down the global economy? I mean, how do you respond to a comment like that you might get from an investor?
You're right, David. We've never had a situation like this where we've literally just shut down the global economy. It's always different. But again, what this chart shows you is the S&P going back to 1900, and whether it's the Great Depression, multiple world wars, the tech boom, or the financial crisis of 2008, 2009, what you see is that the S&P has largely, gone up over time. Again, there are periods of decline. There's no way to get around that. But over time, the markets have gone up as represented by the S&P. So again, this doesn't mean that markets will go up all the time, but it definitely has gone up during, over time. One of the things I wanted to point out too is the gray bars in this chart. And the gray bars represent various recessions that have occurred over time. And what you don't see is a gray bar for the current period we're in. The reason for that is recessions are really backward-looking data. Recessions are officially declared by a group called the National Bureau of Economic Research. And while recessions are often thought about as two consecutive declines of quarterly GDP, again, this group, the National Bureau of Economic Research, is the one to formally declare it. So it's possible and arguably very likely that we're actually in a recession right now, even though one hasn't formally been declared.
Okay. All right, but sometimes a client will say, okay, I understand that I can't time the exact dates to exit and enter the market, but what if I just get the overall trend correct?
Well, that's a lot easier said than done, David, as you know. What we're showing in this graph is really, how missing even just a few days can impact return. So let's look at the bar on the left for the total period. This is showing $1,000 that was invested in 1990, January 1990 through 2019. And through that period, if you stayed invested, you would have earned, you would have had $17,273 at the end of that 30-year period. If you missed the one best day over that 30-year period, again, not many days, but the one best day over that 30-year period, you didn't have $17,000, you had $15,480. If you missed the 25 best days throughout that 30-year period, you had $4,314. So significantly different than the $17,000 you had if you stayed invested. So let's think about that for a minute. If we have a 30-year period, we've got 11,000 calendar days, roughly. We've got almost 7,500 trading days. So we're talking about missing 25 days. That's well less than 1% of those days. Your return difference would have been, almost about $13,000 different if you missed 25 of those best days. So the easiest way to say this is missing out on even a few of those days is going to impact your return. And being that we don't know when those days are going to occur, our philosophy is just to stay invested.
All right, so if the focus is on spending time in the markets rather than timing them, can you talk to how equity markets have performed over various time frames?
The short answer is the longer the time period, the chances of having a positive return increase. So what we're going to do is look at the 1-year time frame here on the left, and that 1-year time frame is, we're looking at going back to 1926 through 2019 in this chart. And what this shows you is over the various 1-year periods, and again, it's just looking at 1-year calendar year periods, about 3/4 of the time we've had a positive return over those distinct 1-year periods. But when you move up to 5-year periods, that number becomes almost 90%. When you look at 10-year periods, that number is almost 95%. And over 15-year periods, it's 100%. So we've literally never had a 15-year period going back, again, to 1926 that has had a negative equity return. And again, that's including the Great Depression, that's including world wars, the recession of 2008, 2009, the tech bubble, and so on and so on. We've never had a 15-year period that we've seen a negative return through history.
Interesting. All right, so the vast majority of our clients at Four Ponds have a substantial portion of their portfolio invested in bonds. What role do bonds play in a portfolio, and how have they reacted?
Well, bonds play a very important part of portfolios. The way we think about bonds, we think about volatility reduction. The equity part of our portfolios are going to be there for what we believe for return generation, but we also know that with return comes risk. So we're mostly investing in bonds to try and reduce some of that volatility that's coming from the equity side of our portfolio. And bonds, continue to play that role in the most recent downturn as well. Overall, high quality bonds, which is mostly what we recommend investing in, have been positive over the last year. You see through the yellow bar in this chart, what intermediate treasuries have done. Again, treasury yields have come down significantly, and we know yields move inversely with prices. So the returns of treasuries have done very well as yields have come down. But we've also seen, over the last year, corporate bonds and muni bonds do well as well. More recently, what we've seen is more of a flight to liquidity, and anything that's non-cash, we'll say, has been hurt by this. So over the last month or two, really going back to the end of the last quarter, you saw munis, you saw corporate bonds sort of sell off a little bit, and that's again just because they're not as safe as treasuries. But what we've seen is, again, over the last month, through April, we've seen a bit of a recovery in corporate bonds and municipal bonds to some extent, while treasuries, have continued to reflect their sort of flight to liquidity status. Overall, bonds and fixed income in general, again, high quality bonds and fixed income can and should be an important part of a client portfolio.
Let me just add a follow-up question here. You used the term flight to liquidity. Can you explain a little bit more what that means and why people or investors may be doing that right now?
Yeah, we saw a lot of that at the end of the the first quarter, and really that flight to liquidity is people wanted cash. People were very nervous about what was going to happen to the economy on a global basis. We were literally and have been shutting down the economy, and with people very concerned about what was taking place and thinking about what the impact would be globally, people were just looking for cash and anything that was sort of risk-based. Again, whether it was even high-quality bonds or volatile equities, mostly everything was being sold off. And you saw that throughout the equities, you saw that throughout fixed income, you saw that throughout almost all asset classes other than cash and treasuries.
Okay. And so is then the reason that treasuries have done so well recently is because people are confident that they can convert those to cash very quickly if they need to?
Absolutely. That's the most significant part of that. Being backed by the U.S. government and how the Fed has come in to sort of backstop a lot of the economy. The treasuries are seen as very liquid vehicles.
Okay. So if you're telling me as an investor I can't time the market and I know I shouldn't panic, what are some of the smart things an investor can do during a market downturn?
Well, David, I'm biased when I say this, but I think for your clients that are already working with 4-ponds, that's already a very smart decision. I say that, somewhat jokingly, but also in with a lot of seriousness. Working with an advisor is a very valuable experience. There's a concept out there called advisor alpha. And really what that concept talks about is, working with an advisor, they're going to help you smartly construct a portfolio. They're going to pay attention to taxes. They're going to walk you through the entire planning process, whether it's your estate plan or insurance needs. They're really going to increase the chances of you reaching your goals. So working with an advisor, you're able to pull out the emotions from a lot of the things that are happening in the news, a lot of the things that you may be thinking about your portfolio, and the advisor is really going to help you focus on that long-term plan that you need to stick with.
We're biased on that point, of course, but I do think it's worth people thinking about. Okay. So Eric, we only have a few minutes remaining. Can you just talk a little bit about where you think the overall economy is now and what factors we might want to pay attention to?
Well, sure. I mean, we could spend hours talking about what's going on in the global economy right now. Our approach at East Bay is really to take a balanced approach to looking at the economy and the markets. We don't want to react too positively or negatively. Obviously we're going through a health crisis, and that health crisis is morphing its way and has morphed its way into the economy and has become sort of a wealth crisis on top of that. You don't need to look further at the new unemployment claims to see what the crisis is doing to the economy. But if we think about things, if we look at things on a positive way, the global central banks have really taken unprecedented actions in what's happening across the globe today. The U.S. has literally, the Fed has literally thrown the kitchen sink at the problem. I think they learned a lot of their lessons from what happened in 2008, 2009. They've been very aggressive and decisive in bringing action to the global economy and the U.S. economy specifically. You've seen some programs implemented and announced that they used in 2008, 2009, but you've also seen a lot of new programs that are entirely new. We can spend hours again diving through what each of these programs are and their intended purposes, but they are essentially acting as a backstop to the U.S. economy and again in parts to the global economy as well. So, that's really been a positive for what's happening. There are going to be some unintended consequences of all their factors as well. But, again, without that action, I shudder to think about where we'd be today. At the end of the day, without a vaccine or medical treatment for the virus, it's likely that some of our lives pre-virus are not going to be able to return to normal as the way we once knew it. We've seen some recovery in the global equity markets, but the duration of the economic crisis is going to be determined at the end of the day by the duration and depth of the health crisis. Part of what's been interesting is that we've seen so many different views on what the recovery is going to look like. Whether it's U-shaped or W-shaped, people seem to throw out all sorts of letters. If we think about what happened with the global economy, we literally just shut it down. So if you think about a light switch, we turned it on, we turned it off, we just flicked the switch. The chances of that happening on a going forward basis, in my opinion, are not as high. If we use that same light switch analogy, if you think more about a dimmer switch, it's turned sort of almost off at this point. I think it's going to be something where we're basically slowly turning it back on eventually until we get to, having it on full power. We've seen, the phases that the government has put into place about how we're going to turn things back on. And I think we're going to see a little bit of fits and starts of how this is going to work, depending upon, again, what happens with the virus, how it spreads, whether there's a treatment or a vaccine. That's all going to be part of what the overall outcome is going to be. And I'd be remiss if I didn't really at least mention what's happening in the oil markets. Again, another topic we could literally spend hours on. The short story of what's happening in the oil markets is that we have a lot of supply. It's really difficult and not easy to shut off all the oil that is being supplied. We don't have any demand really, or not as much as we had before. We're not traveling, planes aren't flying, people aren't driving. And at the end of the day, we're running out of places to store all of it. So, unless you know of, 40,000 gallon drums to store a lot of oil, the places to store all the oil are running out. When you add on top of all of these challenges, how futures markets work, geopolitical concerns between Saudi Arabia, Russia, and the United States, you basically have a recipe for why oil prices have been negative. But if we think about the consumer, I'm going to guess that there's nobody on the call or that's listening that's seeing negative prices at the gas pump. And the reason for that is, again, if you think about it, the refineries still have to refine the oil. It still has to be transported to the gas stations. It still has to be sold. And that's a costly process. So again, while it's theoretically a benefit for consumers that oil prices are lower, the reality is we're not consuming it, again, which is part of the problem. So it's not really benefiting consumers as much as it would if oil prices were lower during what we'll call more normal times.
It's oil actually that fascinates me and what the future outlook it is. I mean, I have to say right now, prices at the gas pump are similar to what they were when I started driving in high school. So that's pretty remarkable. All right, well, I think we need to wrap it up. And, Eric, this has been great. Thank you very much for joining us and helping to explain some of these concepts for our clients and others from a different point of view.
Thanks for having me, David. I appreciate it.